Well. Meet Kevin has a new $3 million bet with $150,000 of passive income. Oh my God. What could this smiling, I don't even know what to say. Look at his face. What does this smiling doofus have to say about his new investment? What could it be? And how does it benefit him? Let's react.
Hey everyone, meet Kevin here. Glad to be back.
So fake.
Excited to share what we've been waiting for. My next 5-year investment. We're going to talk about it in this video. And no, it's not going to be a quick flip-flop. This is a long-term investment for me. And I'm starting with a $3 million investment. I might double that to $6 million. I'm pretty excited about this one.
Oh my God, it's such a good investment that he's going to put in $6 million, not $3 million. What could it be, Kevin? Please tell me.
So what I'm about to explain might, I understand, sound too good to be true. And so I want to be extremely clear. Every investment comes with risk, and you should never invest more than you're willing to lose. It's the nature of investing. Always consult your personal advisor before you make any decisions. With that said, here's the opportunity. I'm investing into something that pays a 5% annual yield locked in for the next 5 years.
Wow, could that be a treasury? What are you investing in, Kevin?
That's pretty cool in my opinion, especially since many of us expect interest rates to drop over the next few years, and savings accounts might end up going back to paying nothing in the future. On top of that, this is passive income paid monthly.
Okay, so sure, rates may drop, I get it. Oh yeah, that's passive income because, buying a bond or buying a stock is passive income. You get dividends, bro. But there's plenty of other options you can invest in that pay 5% right now or close to it that you can lock in. Your alternative isn't a savings account or this frickin' investment. But what could it be, Kevin?
So for example, let's say you invested $100,000. You'd get paid $416 and some change per month, locked in for 5 years, doing nothing.
Oh my God, that sounds like a weird bond that pays monthly.
And here's the bonus. Not only do you get a 5% return, because you might be thinking like, oh, come on, Kevin, like I can get a 5% return today in a lot of different places. Sure, maybe it's not locked in for 5 years, but I want more than 5% potentially. Well, not only do you get a 5% return, but this is where it gets so exciting for me. You also get 100% of the upside of the investment. So if the stock doubles, triples, or even 10x's, you participate fully, 100% at no premium or fees in that growth.
Wow, so what if it 1000x's, Kevin?
If the stock goes down, the company promises to pay your investment back at the end of the term. Now, I know again, it probably sounds a little too good to be true. I get it, but it's not. It's actually a real investment. It's called a convertible bond. Now, usually the
Bum, bum, bum! Oh my God, what's a I've never heard of this. Tell me more, Kevin.
those aren't really sexy. And when we hear that, we first think, oh gosh, bonds, boring. But the convertible part is actually the really interesting part. Because see, bondholders get priority if there's ever a worst case scenario liquidation over other shareholders. And if it's convertible, it means you get the upside.
Yes, that's why your return is freaking limited, okay? The bondholders get a fixed interest rate. I mean, that's pretty freaking obvious, okay? That's why stocks are more risky, but if the company does well, you get all the upside. But a convertible bond combines the best of both.
Now, usually that upside is given to you at a premium, but not in this case. So basically what you're doing is you're lending your money to a company. In return, you're getting 5% annual interest, which you'll get paid out monthly. At the end of 5 to 8 years, if the company's stock price is higher, you might get paid back in stock instead of your cash. You'd have the choice. You could convert to the stock, or the company could convert you to stock after 5 to 8 years.
Or the company could go completely bankrupt, and even though you are entitled earlier than common shareholders, that doesn't mean the company's going to have all the assets remaining to make you whole on your initial principal investment. Did you know that, everybody? Yeah, you could be a bondholder, have first and priority, and guess what? You still don't get a fraction of your principal back. That's a possibility as well.
But the bonus is you are buying in at the 2024 valuation. So it's kind of like having a call option that pays you interest while you wait, which is
wow, I should just put all my money in convertible bond index funds because nothing could possibly go wrong.
like the opposite of a normal call option, although those come with more leverage and they have theta decay and all those Greek numbers and stuff. And then, of course, we should talk about the other side. What if the stock price is lower at the end of the term? Well, if the company's stock price at the end of 5 to 8 years is lower than its 2024 valuation, the company promises to pay your principal back in cash rather than stock.
The company promises, but that doesn't mean they're going to frickin' do it. You could have a company go completely bust because it blew all its frickin' money on horrible real estate investments and you don't get garbage back. Or you may have to wait for years to get your principal back. Imagine the opportunity cost of that. But maybe it's a good, solid company with a solid record of strong earnings. What could it be?
So it protects your downside. On top of that, as if that wasn't already good enough, to make you feel even more secure about the investment, there's more. The founder of the company is personally signing on the debt for the bond. Well, they're personally guaranteeing this bond. That means if anything goes wrong, you've got the founder's personal backing. After all, if banks demand personal guarantees, why shouldn't you get one too if you're basically lending the company money with the hope of getting converted into the company's stock that's hopefully worth more in the future?
I wonder who this founder could be. I'm sure he's responsible and, has a history of making great investment decisions.
Now, of course, there's always a risk with an investment. A riskless investment probably is not a realistic investment. This does come with risk. And so what's the worst case scenario? Well, the worst case scenario is you can lose your investment. If the company defaults on its interest payments or can't repay the debt, then even though bondholders could get paid before shareholders, the company might be forced to file bankruptcy and might have to liquidate its assets, and it could fail to cover the original investments those bondholders made.
That's a good disclosure. I'm glad you told me 5 minutes into the video, Kevin, even though I already freaking mentioned it.
Of course, there's also the founder's personal guarantee, but that all comes down to, well, how much money is available. And so, yes, there is a risk for you to lose your investment. Now, keep this in mind. This investment, it's actually a house hack. Yeah.
Oh my God, it's house hack! Oh my God, I gotta buy this right now. There is no sure way of making your money than, investing with Meet Kevin, lending Meet Kevin your hard-earned money. Yeah. There's no other way I could possibly make money investing than lending it to Meet Kevin. And a 5% interest rate. All right, before this closes on me, okay? So I logged into Fidelity, right? And I looked up current 5-year bond yields. Let's see. Let's go down and look at 5-year bond yields. So U.S. Treasuries right now are paying 3.99% for 5 years. That's what it looks like. That's what Fidelity's telling me right now, okay? So I can get a 3.99% guaranteed return from the federal government. And it isn't subject to state taxes. Did you know that? That's crazy. I can buy agency bonds from federal agencies at 5%, the same rate that Kevin is offering. But it's not convertible to his house hack that's not even publicly traded. Wow. So you tell me, when you're evaluating the risk of an investment, you want to compare it to the risk-free rate, okay? You could lock in 5 years for 4%. You could buy a treasury for 4% or an agency for 5%. Or you could buy Meet Kevin's bond for a company that isn't even generating positive cash flows, that is in its infancy, and get 5%. Which would you rather choose? Look at the corporate bond. You could get bonds from the cleanest companies in the world. Apple, Microsoft, whatever. And they'll pay you 4%. Or you can even lock in for longer term periods and get higher rates. Look at corporate BAA, BBB bonds. 6%. You think Meet Kevin's house sack is less risky than a corporate bond rated BAA or BBB? And do you think the risk premium that you're paying is worth it when you can get a treasury from the federal government? For the largest economy in the world and the wealthiest nation in the world that's never defaulted on its debt? And no, I don't want to hear about getting off the gold standard. You could get that, but instead you'd rather give it to Meet Kevin for house hacks so you can go fly around in his freaking jet, lose money hand over fist, because trust me, he ain't freaking making money. That jet alone is killing his profits. You'd rather give the money to him? You crackheads. Taxable muni bonds. Muni, look at this. You could pay no taxes and get a muni bond for 5 years for close to the rate that he's offering. Do you understand the risk you're taking And the amount of interest that you're getting is outrageously low. I want I want 100% interest rate meat smoker, and I want to get paid up front the first day. What the heck? This is crazy.
My real estate startup. And so that's why I'm so personally confident that not only am I investing more than I already have, another $3 million into this same exact round, this same exact bond, the same exact convertible security that...
Oh my God, it's convertible. I can have shares of HouseHack. Oh my God, I can't pass this deal up. 5% interest, paid monthly. What a freaking meme.
We're offering right now. I'm investing in the same one, $3 million. And I'm personally guaranteeing all of the bonds. In other words, I really want to see these convert at a higher valuation than what our valuation is today. This is my legacy. This is my dream. This is my goal. HouseHack is me. And so I just as well figure if I'm going to ask you to believe in HouseHack, you should have the full faith that I am fully committed. Now, I know this is crazy. I ran some polls on social media to see if, private venture investors ever get a personal guarantee. And over 80% of you responded that no, that's crazy. Why would someone do that?
Should be setting off alarm bells, shouldn't it?
Well, it's mostly because A, I really believe in what we're doing at HouseHack. And B, I think public stock valuations are crazy high right now.
Oh my God. So public stock valuations are crazy. So instead of buying a total market index, you should lend Kevin money for 5% interest when you can get the same frickin' thing from an agency bond. With much less risk. With the backing of the federal government. What a deal!
Some of you already know that I'm a little bit of a bear right now. I'm a little nervous about public stock market valuations. And I think diversifying into something that pays passive income and offers me a great upside option, potentially, is something that's really desirable for me at this time.
But your downside is much more likely. He's talking about, the upside, because my stock might go up. No, the downside is enormous. This is not a cash flow positive business. I would be shocked if they were generating positive operating cash flow. I would blow my freaking mind if he was making a profit, okay? The downside risk is enormous, and it's illiquid. It's locked away. What? So if you want to sell it, where's the open market? You want to dump these bonds, where's the open market? There's a pretty open market for treasuries. There's a pretty open market for corporate bonds. Where's the freaking market for Meet Kevin's HouseHack bond? There ain't no freaking market, you clowns.
It's out of the public market, so it's not subject to, in my opinion, these crazy valuations. And instead, it's a private investment. And the yield is essentially backed by the rent that tenants are paying from real estate that we're buying. The whole...
Oh, show us the numbers, Kevin. Show us the freaking... You're not turning a profit. I guarantee it. Oh, it's backed by the rent. Oh, well, I got, any REIT could issue, anything could be losing money. But it's got rent, bro. It's got revenue by avenue. So, yeah, it's backed, bro. It's personal guarantees. This is bad, dude.
Company owns real estate. It owns about $60 million of paid off free and clear real estate right now. So even with new money we raise, we just expect to grow the rent, and now we can distribute some of that as interest.
We expect to grow the rent, so
as we continue to prove our model. So let me explain why this is such a game changer. So first, my initial plan since our last HouseHack update was actually to take HouseHack public a lot sooner than expected.
Yeah, because you want to pump the freaking stock so you can dump it, you clown.
So we hired a Manhattan investment bank to give us a valuation that they think would work on Wall Street. In other words, what could we sell the stock for on Wall Street? And they estimated that our company is worth 1.4 to 2 times book value, which means every single investor who's invested in HouseHack is up 40 to 100%. Every single person who has invested in HouseHack has invested at a 1 times book value.
No. Okay, look. Most companies trade pretty well above book value. Okay, book value is just the book value. It's the assets minus the liabilities. Most of the book value of his company's in treasuries. He hasn't bought a lot of properties, okay? And it's highly risky because you're concentrated in just a couple freaking properties that you trust Meat Smoker to manage properly by jetting around the country, okay? 1.4 times book value? Wow! What? Go look at the book value of the S&P 500. Go look at the book value of QQQ. And you tell me, is 1.4 impressive? Mostly in freaking treasuries? No, it ain't.
There were some, not many, maybe about 10%, that invested at a slightly higher value, but we adjusted them down to 1x before this offering. So basically every investor who's already in is in at 1x. Now.
And even if you were theoretically up now, guess what? It's illiquid. You're locked away. Oh, I'm up because I bought a property and it's more than book value. Well, you know, you could buy a building for book value. You could buy a building and then the property prices go up a little bit and you can't mark it up. So any amount of fair value that's in there is probably just the fair market value of the properties compared to what he paid for it, which is a natural thing normally when you buy frickin' real estate. There's nothing impressive. Trust me, the fair value of my house is like much higher than my book value. Much higher. But that doesn't mean, you should invest in my house, bro. No. Especially for a 5% freaking interest rate. Look, so we're going to cut this off here. I'm going to go through the filings later. But this is a freaking disaster. There are so many better ways you can employ your money. Even if you want to be less risky than the stunk market. Like a treasury or an agency. Or corporate bonds. Than giving it to a company that isn't even turning a profit that is highly illiquid. And that's in the hands and clutches of meat smoker Kevin. Jeez. Let me know your comment. Let me know your thoughts in the comments below. Check out the pinned comment if you want a sponsored video. Check out my book, Stop Being a Broke Loser. It's on Amazon. And if you want to talk to me one-on-one, you can look in the pinned comment. Have a good night.